You're welcome, Mr. Nyirenda. Limon, not to,
Thank
is it Limon
you.
or
Yes. Limon, I'm okay with that, but I like lemon.
Limon?
Yeah.
Okay, so first of all, I want to thank you for according me this opportunity of, is it interviewing or maybe having this discussion with you?
Yeah.
Because I know
Discussion.
you're a very busy man, but at least you have accorded me this opportunity. So thank you very much.
You're welcome.
Yes, Mr. Limon. Would you please
Yes.
tell me a bit more about yourself? Because I just know that, oh, Mr. Limon is this, is it insurance professional? Just that
Yeah.
I know you are Mr. Limon Nyirenda and an insurance professional. I would like to know more about you.
Okay. Yeah. So I studied initially economics. I hold a Bachelor of Arts in Economics from the University of Zambia. And I also have a Master's in Business Administration, which I acquired from Mulungushi University. Then currently I'm pursuing the chartered insurance with Chartered Insurance Institute from the UK. My career, I've been in insurance for over 8 years now. I joined the insurance in 2012, so I've done more than 8 years now, close to 9. So briefly, I think that's about it.
Okay, that's great. You know, it's very strange to know that you've actually done economics, business administration.
Okay.
Somebody would think maybe you've studied just insurance. Is there even any course that is specifically for insurance? Let's say a degree or a master's in insurance, or maybe it's just a professional course.
Yeah, of course, there are a number of courses for insurance professionals. No wonder I indicated, say, I'm actually currently pursuing a qualification in insurance, though I joined as while holding a degree in economics. You know, the insurance industry accommodates any person from any background. It's something that you can easily adapt and learn. But I think for purposes of you being relevant in the industry, I think it's all good to at least get to study something in line with insurance. We have some institutions in Zambia which offer insurance qualifications like ZBIC. They offer insurance qualification. University of Lusaka, they offer a degree now in insurance and pensions. Also, I'm told CBU has also started offering something to do with insurance at the moment. So I think there are a number of institutions around that do provide qualifications in insurance.
Okay,
Sure.
that's great. So how exactly would you define insurance? I think would everyone that would be watching this video would also want to know what exactly insurance is.
Okay. So in simple terms, insurance is basically a risk transfer mechanism or risk management. So what it is that in life we are faced with a number of risks at personal level, at family level, corporate level. So a number of risks that we're exposed to. So there are certain risks that we can carry on our own, and then there are all those risks that we cannot manage on ourselves. So we entrust the insurance company with those risks that we feel are beyond our financial capabilities to handle. For example, someone who has a car, there are a lot of risks that are involved in somebody owning a car. The vehicle could be involved in an accident, fire could burn the vehicle, or it could be stolen. So that's a risk that somebody has who has bought a car. And you know, these risks come with financial implications. When your vehicle is involved in an accident, you know that you have to put it back in its original shape. So there's a risk in you losing money when there's an accident. So what you do is, wow, what can I do? I can't manage this risk on my own. I'd rather I take this risk to the insurance company. So basically, insurance is all about risk management. So an individual will transfer this risk that they have to take it to the insurance company. So that in an event of a loss, the insurance company comes in to help them out, sort out their losses. So basically, it's just risk management. In simple terms, it's just risk management. That's what insurance is all about.
Okay, that's wonderful. And speaking of motor car insurance, obviously most of us know about this motor car insurance. However, this program today, this discussion is about home and property insurance. I would like to know why most of us just concentrate so much on motor insurance and rather than home and property insurance? What would you say makes so many people concentrate so much on motor car insurance than home and property insurance? Or do they even know about it?
Yeah. So I think it's in two folds. Number one, it's to do with awareness. Very few people know that they can insure their property, for example, their home. Very few people know that there's insurance cover for such types of properties. So on one side, it's to do with awareness. A lot of people do not know. You'll be interested to know that currently, I think the statistics just changed now. I think only about 5% of the population are insured right now, which means 95% of the population is not insured. So out of that 5%, again, you find that there are very few people that know that they can insure a home. So 3/4 of those just know about motor insurance. So on the second fold, you find that the legal requirements. So you find that for motor, it's required by law to have your vehicle have the basic level of insurance on it. So because of that, people tend to get forced. Other people would not want to insure, but because the law allows you to have a vehicle with insurance before you move it on the road, so that forces people to get insurance. But for homes, currently there's no legal requirement for you to insure your home. So you find that very people don't have that, incentive to have their homes insured. So it's to do with this awareness, again, the legal requirement. I think that's what is making a lot of people not to insure. But once we increase our awareness levels so that people may be able to understand the importance of home insurance, I think we'll be able to see numbers increasing in terms of people insuring their homes.
When we insure our vehicles, most of the times we look at the value of the vehicle, and mostly the value of the vehicle will determine how much premium you pay. So most people might be thinking that if insuring a car that is cheaper than a house can be somewhat expensive, how much more a house? Maybe would you kindly explain how that premium is calculated when insuring property, which is obviously much more expensive than a motor vehicle?
Okay, so it's so funny. Yeah, when you look at the value of a house, obviously houses are valued more compared to most vehicles that we own around here, and unless those fancy, very expensive cars. But most of the homes that we have are way expensive compared to the vehicles that we drive, especially the so-called .coms from Japan. So one would obviously initially think that if I pay 3,000, 2,000 for a car, then what more am I going to pay for a house valued at maybe 500,000, 1 million kwacha? People would think you pay a lot, but surprisingly, home insurance is actually very, very, very cheap compared to a car. Why? Because the risk factors are different between these two items. A car has got a very high risk exposure compared to a house. The car is always on the move. There's risk that you yourself could be involved in an accident. There's a risk that another motorist might hit into your vehicle. There's a risk of theft, which does not which is not very present for a house. No one will come and steal your house. Of course, they might break in and steal one or two things, but they can't steal the entire property. So the risk profile of a car and a house are different. So in coming up with the premium, we factor in all those things. So at the end of the day, you find that premium for a house which is valued at 1 million would be actually lower compared to a car valued at 50,000 kwacha. So of course, there are other factors that we look at in coming up with the premium, but basically a house is way cheaper in terms of insurance compared to a car. So for a car, the risk profile, the risk exposure is too high. For a house, of course, yes, we look at maybe the material involved in constructing a house. We look at what kind of roof, what kind of wall. Did they use brick? Did they use concrete? Did they use metal? Did they use things like glass? So all those things will come in to determine the different types of structures in terms of coming up with premium. Yeah. So of course, for a house, for properties, there are different types of properties. Materials used in building these properties. So each property we may not have a standard premium for all the properties. So we look at the different types of materials that go into building the property, you know, all those kind of things, and coming up with the premium. But basically, the premium for a house is actually cheaper compared to that of a car.
Wow, that's wonderful. Mr. Nyirenda, actually, I didn't know that you also factor in the risk of exposure, because I was actually thinking that insuring property or a home is much more expensive than a vehicle, but I didn't know you factor in the risk of exposure.
Of course, that's a very important component in coming up with a premium.
Yes.
Yeah, even for a car, we also look at the character of the individual. So when two people have come to insure a car, there's a proposal form. I think you've seen it, where we ask a number of questions. For example, somebody who drinks a lot will be charged a higher premium compared to somebody who doesn't drink, because the risk profiles there are different.
Okay.
Yeah.
So it's about time we started lying about our drinking habits.
No, a lot of people actually lie about it. They don't admit that they are drunkards, you know. Yeah.
Okay, so how does one go about accessing insurance for homes and property in general?
Okay, so it's easy actually. Once someone has a property, all they need to do is come through to our offices. When they present their case to us, we ask them to submit an evaluation report. That is very important, because that will help us to know the value of the property. 1, 2, it will help us to know the location of the property. Then also, I think some valuation reports do indicate the type of property that this person has, the type of home. Like I said earlier, this will help us. Of course, I will also do our own survey to be able to know how the structure is, because this is very important in us coming up with a premium for the property, for the house. So we look at the walls. How were the walls built? Like I said earlier, is it block work? Is it brickwork? Is it steel? All those kind of things. The plastering, did they use cement plastering? Did they use gypsum? Did they use aluminium cladding? All those kind of things. So some of the valuation reports will have all this information in them. The roofing, is it sheeting? Is it slates? All those kind of materials that people use in doing their roofing. Their ceiling boards, how is it done? All those kind of things. So once they give us a valuation report, we'll be able to know and tell what kind of a structure we're dealing with. And then also the valuation report will be able to indicate to us the value, because the valuation report will put the market value, will put the insurance value, and the replacement value. So we'll be able to pick the insurance value from the report and be able to do a quotation for them. If they are happy, they complete a proposal form, and then we place cover after we do the survey, to just know that actually this property exists. You might see that somebody is bringing a property that is already maybe damaged to insure. So we have to first do a physical survey to just make sure that the property is there. What the evaluation report is saying is actually what is prevailing on the ground. Then after that, we'll be able to issue a quotation. After we issue a quotation, you are happy, or we negotiate on the cost. And then once we agree on everything, then we'll be able to proceed with issuing cover.
Okay, so most of us know that when valuers are evaluating a building, they also consider the landscapes, and most of these landscapes also comprise trees, flowers, the driveways. In case, for example, a tree is burned down or it's struck by lightning, can somebody come and claim for compensation in that case? Because they love this tree so much and it's been cared for so many years, say 10 years, 20 years, there's been a lot of investment. So can somebody come and claim for compensation in that case?
Unfortunately, for a tree, it's not covered. I think I should have also taken a bit of time to just describe exactly what is covered.
Yes.
Under a home and also under other properties, because like I think you indicated earlier that we're discussing the home insurance and the property insurance.
Yes.
So under home insurance, we have what we call a combined domestic package policy. So this is combined because we have two items there. We've got the physical building itself, the house itself, the fittings, the walls, the roofings. This also includes the things like the swimming pools, the offense, the pavings, every structure that actually has been constructed on that particular place. So we look at things that you've actually constructed yourself there, the house itself. So this is the first part. The fixtures and fittings, maybe you fitted in the kitchen units, the wardrobes, those are fitted in, those are part of the building. Then the second part is the household items. The household items also are covered under the home, this domestic, combined domestic package. So we look at the things that you have in the house, your properties actually, the chairs, the fridges, the stoves, and things like that. Okay, yeah. So this is on the home. Then on the property insurance, now we look at the commercial and industrial risks. This is where we look at things like shops, office buildings, shopping malls, and other kind of properties. So these are insured differently. So for the home, this is where we look at the domestic package, where we have what we call house owners insurance and householders. House owners insurance basically just looks at the house itself, the building itself, without taking into account the properties inside. Then the householders now takes into account now the actual items in the home. I know a lot of people don't know that you can insure your fridges, you can insure, your sofas, your beds, and things like, yeah, all those things you can insure. There's theft. Somebody will break in and steal all those things. Yeah. So you would want to have those things compensated. So you can even insure food in your fridge sometimes. Okay. Though, yeah, those are some exclusions to that end. But basically, this is what home insurance covers. So it's the building itself. Outside the building, we look at the swimming pools, those are covered. We look at the boreholes, those are covered. We look at it, if there's a tennis court, all those are covered. The pavings, if you've done paving on your yard, all those things are covered, So, and the office itself is also part of the building structure. Yeah, then also the household items. So basically, that's what the home insurance is all about, in simple terms.
All right, that's great to know, Mr. Nyirenda. I'm actually learning a lot. Most of the time we get to lose utensils in the house because our friends came and liked it and got it. I would like to know in what circumstances somebody would actually access compensation when their home or property has been insured. For example, I've just said that in instances where you lose something in the house, probably because a friend came and liked it and sneaked it out of your house without your knowledge. So in what instances would somebody be eligible to access compensation? Can you come and claim for compensation in such a case?
So basically, the only cases where we would want to compensate is where we can prove unexplained losses are not covered, where you just say, no, I had this item, but it's gone missing. I don't know how it's gone. So we want you to explain how it's been lost. You should have evidence. Say, no, maybe it fell down, or maybe somebody broke in and if there was a breaking, we have to see the physical, aspect that, okay, yes, this door was broken down or this window was broken down. So there was forcible entry. There's evidence of forcible entry into the house. Cases where something goes missing, maybe somebody came and sneaked out with something. Those, unfortunately, are difficult to prove because we work on actual losses. So we want to see the evidence of something being lost. So, like I said, for instance, if your TV has been stolen, obviously there will be some sign that somebody broke in the house. Okay, you will not just say, no, the TV has gone missing mysteriously. Mysterious disappearance. I mean, how? No, I don't know, but we were sleeping. Was the door open? No, the door was closed. But how did the TV go missing? Such kind of things. So we want losses. Allowed. Yeah. So at least if it's for property in the house, there has to be some form of force. Somebody used force to access the house. Or maybe the kid dropped the TV. We come and see, oh, the TV has really dropped down. Such kind of losses. And then for the house itself, it could be a tree, like a tree. You said a tree falls on the house. Yeah. Of course, we'll come and see damage on the house. Suddenly, maybe there was a short circuit, the house catches fire. Those are physical things to see, you know. Maybe something falls down on the vehicle, a plane is flying in the sky, suddenly it loses control, it crashes on your house. Those are the kind of losses that we compensate. Maybe there's a water line passing in your house, and then the pipe bursts. You know, when some pipes have got force. The water in the pipes have got force. So if it bursts, it can cause some damage on the property. You know, so all those kind of losses are covered. And then there are some properties that are along the main road. You know, a busy road. A car might lose control, comes and hits into the fence, hits into a house. Those losses are compensated.
Okay.
Yeah, basically, so those are some of the losses that we compensate. But anything that is unexplainable, mysterious, those we are excluded.
And acts
because
of
now it becomes a back and forth.
How about acts of God, like a disaster, an earthquake, or something of that sort?
An earthquake is covered.
Okay.
Earthquakes are covered, but what we don't cover are catastrophes. You know, where for example, it's something that is affecting an entire town. You know, for example, something has happened and all the houses in Kawe are damaged. You know, you can imagine the amounts involved in that. You know,
yes,
it's catastrophic, so it becomes very, very difficult for the insurance company to come in. Then other things that are not covered are things like terrorism. Okay, if there's a terrorist act and then it results in losses, those are not covered. Or political risks, where there's a riot because of politics, you know, your house gets damaged, those are not covered.
Okay.
You know, war, invasion, you know, if a war breaks out and then there are losses because of that, those are also excluded. But any other loss, any other risk that results into loss is covered.
Okay, that's understood.
Basically.
Okay.
Yeah.
So are there different types of home and property insurance? Or is it insurances? Because for motor car insurance, we know there's comprehensive and third party. So are there different types, or there's just one type? And if there are types, please let me know, or let us know the importance of each one of them, the importance of going for each one of them, advantages and disadvantages.
Okay, so basically for home insurance, the cover that we provide is actually comprehensive in nature. Okay. Because it's a multi-peril. You know, it covers a range of perils. So basically the one that we have for properties or for home is actually a comprehensive in nature, because it's a multi-peril type of insurance. It's different from a motor where you can select, say, no, I just want third party. In case third parties are, you know, the ones involved, just compensate third party. But for the house itself, it's actually a comprehensive cover. The cover that we have is comprehensive in nature, and it has a range of perils in it. There's fire, there's lightning, there's theft, you know, if an aerial device drops on your house, if there's flooding, it's compensated, if there's earthquake. So you can see the number of risks of that are covered in there. So at the end of the day, it just becomes a comprehensive type of cover. But of course, the commercial and industrial property, risk properties, for example, I was talking about shops, those are covered under different type of cover. Those are covered under what we call fire and allied perils. Okay. But for the homes, we cover it under household insurance, or householders insurance and house owners insurance. But basically, the cover is basically the same. We just separate it, we just give that distinction between a residential property and a commercial property. And the risk profiles, of course, are different between a home and a shop. You know, a shop, one is used to make money. You know, a shop, there are a lot of people that walk into a shop each day. So the risk profile also are different there. So even the premium for a shop and for a home are not the same. Of course, for a shop and maybe office space, the risk is higher. For instance, if you've got an office park, there are a lot of tenants there. So you can't control the behavior of each and every tenant. So therefore, it renders that property very exposed in terms of risk compared to a home where there are just 3-4 family members, you know. So the premium for a property and a home are different. So for a property, the premium will be slightly on the higher side, but of course it's still cheaper than a car. It's still cheaper than car insurance. Yeah.
Okay, so speaking of
No, it's comprehensive. It's comprehensive cover.
okay. Then speaking
Yes.
of office space and shops being money-making ventures, we also have flats and houses built specifically for money-making. How do you cover insurance in that case? Of course, it's a home, but it's for commercial purposes.
Yeah, of course, it's for commercial purposes, but where because in the when you come for insurance, when you give you a proposal form, you're able to indicate to say, are you the landlord? Are you the one occupying this, or maybe there's a tenant occupying it? If there's a tenant occupying it, obviously we'll raise the premium slightly higher because you know, people's behaviors are different. The way you would keep your house yourself and the way somebody else would keep your house is different, you know. So, but basically the difference is not much by virtue of it being a home. It's used for just for dwelling purposes. You know, those people that are staying in there obviously are not trading in it. It's just for, you know, dwelling purposes. So obviously we will not penalize that owner of the house because he's using it to raise the income. No, but for as long as it's themed as a dwelling property, then we'll take it like that. We'll not penalize them or charge them very high premium because it's for money, no.
Okay. You know, as this discussion progresses, more questions are coming up because you're talking of the dwelling places, categorizing homes as dwelling places only has me asking why, like how you can calculate the premium of insurance if this place where a tenant is staying is also used as a selling place. For example, maybe that tenant even rears chickens, maybe in the bedroom or something. So how do you come up with premium? How do you consider that? How do you deal with that, with such a case?
Well, like basically for such, like I said, we do not put so much distinction, you know. Okay. And obviously, when we come, we will not, you know, go in the house and check if you are keeping chickens in the house, unless you disclose, say no, we are keeping chickens in there. Then we know that the house now, the risk of damage is higher because now it's not used for the intended purposes of, you know, maybe just occupying it as a house per se. Okay. So of course, unless you disclose that no, it's actually not used as a dwelling place per se, it's now become commercial. It's now become very commercial. Then now the risk profile changes, and then now we start factoring now the rates for a commercial property now. So we'll not charge you now as a home or as a residential place, but since now it's for trading, we charge. Like there are some homes where there's a shop, right?
Yes.
There are some homes where they've built shops in there. So that one now it becomes a home, and then there's also a business there. So of course we know that the shop there exposes the house. It's easy for people to target that home because they know that the shop there, they're making money in there. So there's a high risk that there's a high probability that burglaries will be happening every now and then there. Okay. So when we'll be charging you, we'll put a load, we'll load extra premium on that property because we know that client A who doesn't have a shop at their place, at least they don't face the risk of people coming there because there's no attraction to them. When they know that there's a shop there, people are making money in there, so it will be targeted, you know. So we'll raise the premium, we either load the premium or we'll raise the rate higher. Instead of using the standard rate, we increase the rate slightly higher or put a loading on it on the premium because of that factor.
Okay, so I'm going to dwell a bit more on rental property because most of us are buying land and building for commercial purposes so that we lease out or rent out our property. Yes, so when
So,
a landlord comes to insure his or her rental property, when calculating the premium, do you calculate just for the building or even the utensils that the tenant is going to come with? Or does the tenant have that responsibility on their own of insuring their utensils in case of a fire or something like that?
okay. Okay, so in that instance, it brings me to there's one principle in insurance, what we call insurable interest. So you can only insure something that you've got interest in it, that is financial interest. So you need to have insurable interest in it. So one day the landlord has got insurable interest in the house, the structure itself, because that's their property. They spent money on it. But on the actual items in the house, they do not have interest in there. So they cannot insure the properties in the house, maybe the stoves, the sofas, the fridges, because they don't have an interest in those items. They're not their properties. So in this case, the occupier of the house, the tenant, can separately take up cover to insure their properties inside. Okay. So if for example, a tenant takes up cover to cover their properties in the house, and then the landlord also has got cover for the building. If maybe there's a fire and both the properties in the house and the building is gutted, so both parties will be compensated separately. The tenant will be compensated for their items inside the house, and then the landlord will also be compensated for their building, for the loss to their building. So they can only insure something that they've got insurable interest in it. If they don't have interest in it, it cannot cover. Because if the landlord insures the properties inside, the fridges, the stores for the tenant, if there's a loss, we are going to say, who is the owner of this property? No, it's my tenant. And then we'll compensate the tenant. We will not give them to you. And moreover, there will be a conflict there. Again, when the tenant comes and say, no, I've come to get compensation for the items in my house, but are you the one who insured? How are you claiming for something that you did not insure? Did you pay premiums for them? So there's a conflict there. So they can only insure things that have got insurable interest in them.
Okay. I hope somebody is getting this and they won't go and storm their landlord when there's a fire at their rented property.
I hope so too. Yeah.
Yes, then earlier you had mentioned that when somebody wants to insure their property or home, they have to have their property valuated. So I wanted to find out, in a case where this property owner doesn't really have funds to go and hire a valuer, does the insurance company come in to help value this property? How do you help out those that feel they can't really afford to insure their property in those terms?
So unfortunately, the insurance company is not in the business of evaluating properties. So we do not want to, go into the business of other people, so we don't value properties, but what we do normally is there's a what can I say? There's a limit in terms of value of properties that we can accept to insure before an evaluation report is submitted. So for example, all properties, I think now valued up to 1 million, we can grant cover if they don't have evaluation report. They'll just indicate to us, no, this property is valued at so much. But it will be a requirement that during the course of the insurance period, they will be able to at least submit. Or when there's a loss, when there's a claim, maybe there's a fire, the house has been gutted by fire, they should be able to produce evaluation report for purposes of paying. Because why we want evaluation report in the first place is, when there's a loss, it's an issue of the insurance company and the owner of the property. No, my insurance, my property was insured, was valued at so much. No, you underinsured. So when there's a valuation report, it's clear. It helps us know exactly how much the property is valued. So it's something that is very important to us. So if the individual is not able to afford the valuation report at the time of insurance, if the property is valued less than 1 million, we can accommodate to cover that property, but at least they should be able to try and be able to get a valuation report in the course of the insurance before it expires or before there's a loss. So we'll put a note in the policy to say this cover has been issued subject to submission of a valuation report. So that's a very important requirement, but we give that leeway to say anything below 1 million we can cover, but this does not mean that we are waiving the requirement for evaluation report. No, we're just saying we'll accommodate, but with time we should be able to arrange for evaluation report. But we give references to people that do evaluation.
Okay. So
Sure.
we have a lot of people making modifications to their property every now and then. In a case where somebody has already insured their property, say for a year, and the premium is for a year, obviously, then this person or this property owner makes modifications that either increase the value or even reduce the value. In that case, how does the insurance company go about the premium? Does this person or this property owner have to come to the insurance company and report all the modifications, or what exactly goes on in such a case?
Okay, thanks for that question. So basically, I think we have those cases from time to time where somebody comes and say, no, actually when I was insuring my vehicle, there was no offense. When I was insuring my vehicle, I didn't have towers. Because for us, for home insurance, you can actually insure your house as you are building it before it's even completed.
Okay.
So, as you keep on completing the house, you doing paving, all those, the value keeps changing, Once you put up a fence, the value changes. You tile, the value changes. When you pave, the value changes. So basically what we need is when you feel like you've added value to your house, you just come to us. What we'll do is we'll increase the value, and then you just add on a small premium to cover for that difference in increase in value. So it will be proportionate to the increase in value. We just calculate, okay, you paid this premium, or now the house is valued at this much. What's the difference in terms of premium that you can add on? Then you just add on, and then we'll increase the value. Will not say no because we're already insured, then you can't add on. No. Once you make any improvements, you tell us, okay, I've done this improvement. We come down to the ground, we do our survey, we inspect. Oh yes, you put up this, you put up that. Therefore, we are all agreed to say, okay, yes, the value has changed now, maybe from 300 to 500. Okay, we'll increase the value. We'll do an endorsement on the policy. We endorse the policy and then just increase the value and also just change the premium a little bit. So basically that's what we do, but we have these cases from time to time. It's not strange. Okay. So actually that's a very, very, very good point that you raised. So we do have these cases, and we are flexible in terms of allowing for that increase in value.
Okay, so I've just been thinking about this property. Obviously, even bare land is property. So is it possible for somebody to come and insure bare land? Is it possible? Because sometimes you might encounter legal disputes. How can the insurance come in? I don't know.
No, for bare land, no. We don't insure bare land. At least there has to be some structure of some sort.
Okay.
Yeah.
Then you mentioned that very few people know about this insurance, probably because of sensitization. Would you, Mr. Nyirenda, tell us why exactly you would encourage me or any other property owner to insure their property? What advantages really do they have? The greatest advantage of insuring property?
Okay. So the number one importance of insuring any property, be it vehicle, be it a home, any form of property that you own, is peace of mind. It gives you that peace of mind. That's number one. Because you can go sleeping, you can go on a work trip. You know that if anything happens to my house, at least I'm covered. I may be inconvenienced, but at least I know I'll be compensated, and I'll be able to build or buy another property. So number one, it gives you peace of mind. Number two, it secures your finances. It secures your finances. You know that when there's a loss, any loss, usually there's a financial implication to it. Okay, Imagine a car that costs you 50 pin, it gets damaged. You just need to replace maybe a bumper. You go to a garage and tell you a bumper costs 5,000 kwacha. It may look small, but it will inconvenience you. It will inconvenience your budgeting and things like that. Now think, what more of a property? What more of a home? You know, you are just at work and then you hear that, no, your house is on fire and you don't have insurance. You can imagine the emotional havoc that you'll be going through. Eh?
Yes.
It's something that is so sad. We've had cases where houses have been lost, and some study that was conducted, I think last year, globally, I think there are over 500,000 homes that were burnt with fire.
Wow.
And then there were about 5,000 burglaries, break-ins in homes. So all those have got financial implications to them. So at an individual level, you can imagine how you'd feel. You are just at home working and then you hear that, no, your house is on fire. So you think about how much you've put in the house, how much has gone in there. And then if you didn't insure your property, now you think about, where am I going to get money to start reconstructing now? And you know, so most of us, you know, we get loans to insure this property, to build these properties. There are very few people that just build with their own cash. Even if you build your own cash, again, it's still money that you do not want to just lose. Imagine you've got a loan that you are saving for 15 years, and then you hear that the property that you built using that same loan is on fire. So you've got a property that is lost, and you've got a loan that you are saving. You know, you have BP, you can even die if you're not strong. So it's very important that people insure, because one, it guarantees your peace of mind. Two, it secures your finances. You know, it helps you plan better. You know, it helps you plan your finances properly. It's one way of practicing financial literacy in a way, because you know that if anything happens to this, I don't have to go to the bank, get my savings to start, you know, reconstructing my property. No, I can use this money to invest in other things. So the insurance company will take care of whatever risk my house may be exposed to. So I think that those are the most two things that, again, just say off the head. Say, number one, it guarantees you peace of mind. Two, it secures your finances. Simple as that.
It's true.
So it's very important. And I would encourage a lot of people to seriously consider taking up home insurance. I, for one, I do. I'm not just speaking from that. I insure. Even the household items, I insure them. I don't want to be caught unaware, you know.
Okay.
So it should be a lifestyle. It should be a lifestyle. And I pray that, you know, I think it's upon us, the insurance guys, to do a lot more sensitization. You know, a lot of people are aware about what insurance is. I think we haven't done much in that area. Like I said, I think most people just know about motor insurance, but for home insurance, if we ask around, we do a survey or a research here in Kawe, you would find that very few homes are actually insured. And the properties in town, actually, you find that very few are actually insured, because people don't see the value, they don't know. You know, and people think as if, what can happen to a house? But things happen to houses. You know, in Kawe, I think in 2016 or 2017, in Poland, there was a house that was gutted.
Okay.
There was a house that was gutted, and we compensated the owner.
Okay, that was wonderful.
Now you can imagine if they didn't have insurance, I don't know what would have happened. So the man was actually coming shaking. You know, he was coming shaking. He didn't believe that we can compensate.
Yes.
And then we compensated him. We couldn't believe it. Up to now, he says, "I'll never live without insurance."
Okay.
Yeah.
You know,
so those are just a few testimonials.
Especially in these times of load shedding. Although
exactly.
at the moment we don't really experience this load shedding, but when we have a lot of load shedding, sometimes the power can be restored with so much energy, and it burns down your equipment, your appliances. So it's very important to have insurance covers, I think.
Even if you sue Zesco, they'll probably not even compensate you. So you just need to have the cover. Yeah.
Then, you know, sometimes when we experience these floods and whatnot, the government can only fund you or help you so much. So like in the case of compensation, do you fully compensate, or maybe there's just a percentage that you compensate?
So in terms of compensation, in insurance, there's what we call excess. There's what we call excess. Excess, it's a part that is not covered by the insurance company. So the standard being 10%. So the risk is 100%, right? So out of the 100%, 10% is your own insurance, you as the owner of the property. So what we are going to pay as the insurance company is 90% of the loss. So this could be a standard like this. Sometimes we can pre-agree with you to say, okay, we put excess maybe at 5%. We can put excess at 10%. We can put excess at 20%. But the standard one is 10% in most of the insurance companies. So when there's loss, if your property is insured at 600,000 kwacha, when there's a loss, we're going to take away 10% and we're going to pay the difference. So 60,000 will be covered by yourself, as we're going to pay you 540,000 kwacha. So we don't pay 100%. Okay. That's why when they're doing valuation, when we are putting the insurance value, most of the times you find that the market value is a bit lower compared to the insurance value. Why? Because they know that there will be issues of excess and these other things. When the adjusters come in, they'll be able to look at this, look at that. So the premium, the amount to be paid will slightly go down. So the insurance value is actually slightly higher compared to the selling price. So we don't pay 100% unless there are circumstances where you say, I want to buy back my excess. Okay. You can buy back your excess. Even for motor, you can say, I want to buy back my excess. What this means is that when there's a loss, we're going to pay you 100%. We don't have to withhold the 10%.
Okay.
So when you're paying the premium, we'll be able to charge you slightly higher for the excess to be waived. So that in case of a loss, we'll pay you 100%. Instead of paying you 540,000, we're going to pay you 600,000.
Okay. That's wonderful. Yeah. I've never heard of that. You know, I've learned a lot just from this discussion. I'd like to know why.
No, you don't. The only thing is that when we give documents, most people don't read.
Yes, that's.
They say no, it's open. They know it's bulky. It's bulky. No, it's all in there. You know, it's all in there. That's why people don't read, and people don't want to pay extra more. You know, when you tell, just add on like a 10% so that we take care of this, people think as if, no, I just want to get my money,
Yes.
But actually, we're looking out for you.
Maybe kindly tell us why you remove that 10%. Why do you remove it? Why not just give out 100% instead of somebody paying excess for excess, whatever?
So the basic idea behind the excess is to put some form of responsibility in you.
Okay.
For example, if you own a vehicle, when you say no, when your vehicle is involved in an accident, when you take it to the garage, 10% is paid by you. So because you know that there's an amount that you are going to pay, you'll be more careful than knowing that everything is covered 100%. So it's basically to just instill that level of responsibility in the owner of the property. Say, no, actually, if there's a loss, I also stand to lose something. So it's just to create that level of responsibility in someone. So basically, that's the whole point about excess.
Okay, I see. And you know
about, so you don't walk away freely.
Yeah.
About so that you don't just walk away freely.
The issue of reading instructions, the terms and conditions. I'm also a culprit of that. I don't really read everything because maybe the time is too little that's given, because when somebody is buying insurance, they're expected to sign this and that, and maybe they are busy, they just want to be done away with everything, so they just sign without even reading. How do you go about that? How do you help the clients to understand the terms and conditions? Because obviously somebody might just be signing anyhow without understanding what's going on.
So basically, like for us, what we're doing now is before you take up cover, there are two forms that we give. We'll give you the proposal form. So proposal form is more like a questionnaire. So you'll be answering basic questions there. Do you want to take up this? Do you want this? What type of cover? Is this your vehicle? There'll be a lot of questions that you'll be answering there. And then when you encounter a question that you feel you're not sure about it, we're able to explain there. And then also before you go, we also give you what we call a KFS, key facts statement, where we are basically just describing the cover about that particular property. If it's a vehicle, if it's a house, so this is what is contained in this thing that you bought. Read through, and then you sign for it before you leave. So you'll be able to read there. Say, oh, this is what is covered, this is what's covered. If you're happy, you sign, you go away. If you're not happy, you'll be able to say, but explain to me here. We'll be able to go through. Even then, there's some people that say, nah, no, let me just sign. I'll go and read at home. I know, but you have to read and understand before you go. But people, because they feel like it's taking a lot of time and things like that. But we do encourage people to, you know, yeah, read.
Okay.
Excuse me.
Thank you very much, Mr. Nyirenda. I think this is all from me, unless you have any other information you'd like us to know.
In concluding, all I can say is I think it's about time that people take home insurance seriously.
Okay.
We can see the cases around. It may be not very prevalent, but I think the risk is there. Like you said, issues of load shedding, though they've gone down slightly now, but there's always a risk that something can happen to your house. You never know. Okay, you never know. Just like when you wake up, we don't know how the day is going to be, so you don't know how your property is going to be. So I think it's very important that I think people get to take home insurance seriously. It will save you from a lot of stress, give you a lot of peace of mind, and it will save a lot of your resources if anything happens to your property. So from me, all I can say is take this up. It will help you one day. You never know, but it will help you one day. The premium is very small. So it's better you just spend a little, but you know that you've secured your property and you have a peace of mind.
Thank you very much.
Thank you for having me. It's been a pleasure. I'm grateful.
Okay. Ladies and gentlemen, we have come to the end of this video. I hope you have learned a thing or two and have decided to start thinking about insuring your property because it is for your own good. I'll see you in the next video. Bye-bye.